Good morning from our world headquarters in New York. I'm Manus Cranny with Danny Berger in Paris on the road today, speaking to private equity titans. Welcome to Bloomberg Brief. Let's set the agenda. Oil rally gathers pace. Brent touching $95 for the first time since November. Chevron CEO tells Bloomberg, $100, it's in sight. Job cuts could be on the way at Santander. The bank revamps its structure as its new CEO looks to simplify operations. Plus, in this pivotal week for markets, we get the exclusive conversations with two private capital titans. Blackstone's CEO and the CEO of Oak Hill Advisors join Danny and I this hour. A little bit of breaking news coming in from the OECD on their latest perspective for the economy. They raised the 2023 world forecast. This is for global growth. For 2024, so they're raising, and they're raising for this year, and they are saying 2023 and 2024. My apologies, they are cutting euro area growth. They're cutting China GDP forecast for 2023 and 2024. It's going to get tough out there. And that is the reflection in the cross-asset whip this morning. You've got the oil market, which is dealing with the pressure. You've got the stock market dealing with the pressure of oil and the potential for a hawkish hold. That is what you're really dealing with there. Now, below that stock market, you have an oil colossus, the likes of Halliburton, Conoco, Exxon up 6%. So the musculature of the Brent market and the WTI market is carrying through in one portion. The best performing sector in the S&P 500 this month is the oil sector. And with that in mind, the Brent contract breaks the $95 level for the first time since November. We listened to Prince Abdulaziz bin Salman yesterday saying the jury is still out on Chinese demand. OPEC, we're not trying to jack up prices. We're not going back to the 1980s. And then you have a whole host of voices coming in talking about the ability of $100 oil. That's state of play. Yields are 431 this morning, ticking ever so slightly higher. Let's get to Paris. Danny's got the first exclusive of the day with the Blackstone CEO. Danny, good morning.
Good morning, Manus. Thank you so much. That's right. I'm here in Paris. I'm sat with the Blackstone CEO and chairman. That's, of course, Steve Schwartzman. Steve, thank you so much taking time out of your world tour to talk with us here in Paris. Look, we are here in Paris. We're here in Europe the week after an ECB hiked rates, confronted with sticky inflation, weaker growth. The risk is constantly changing. How do you think about risk in this European region?
Well, I think Europe is slowing down. It's pretty clear that there's certain countries, for example, Germany, where I was yesterday, where growth is slightly negative. I'm in France today. We've got an expansion of our office here. And France is doing the best of the European countries, and I think has been the biggest beneficiary of Brexit. I think the government's done a great job making France attractive, Paris attractive. But as the central bank continues to raise interest rates, no one ever knows where these things stop. It's certainly suppressing growth. So I think it's a reasonable expectation for Europe over the next year to have pretty muted performance.
Does the ECB need to stop soon for fear of it not just being muted, but a full-on recession?
Well, that's up to Christine, not to me. I think inflation's still pretty high here. It's in the fives, and you can't stay at that level. And so the central bank typically would do what it needs to do to lower that.
Steve, ever the diplomat. One source of support for Europe, though, that we don't have, that we thought we would have at the start of the year is China. We came into the year thinking China would be this huge source of global growth. Now we're just hoping for more large-scale stimulus. Have your assumptions about China changed this year?
Well, I think they did change. I was in China in April, and my expectation was that there would be a pretty rapid bounce back. But what I found was that people really had a tough time over the last 3.5 years. They had a real estate crisis for a while, and that became more pronounced as they actually had to meet maturities. And the Chinese people tend to put 80 to 90% of their savings into real estate. So when real estate goes down, it really takes away confidence, because nobody likes spending a lot of money as their net worth is going down. It's just not how humans work, whether they're Chinese or any other place. And so it's difficult for China now, in the face of that, to have the kind of rapid growth rates that we're having. And Europe has been a big exporter to China. China has provided, over the last 10 years or so, before COVID, probably half of the world's growth.
So what does the opportunity set look like for Blackstone in China then? Is there still opportunity, or do you need to wait?
I think most people, including the Chinese, are taking a wait-and-see type of approach. One of the things with China is they often make mistakes, but they typically don't continue making them. And they don't have a lot of pride in wrong decisions, and they're practical. And so it's, in a way, a matter of time before they make the appropriate adjustments and start growing again. But in the short term, I think it's going to be somewhat difficult.
Steve, if I can take you back around 4 decades, when you founded Blackstone, just $400,000 in pocket and capital, to now $1 trillion. How do you get to the next $1 trillion?
Well, we just keep doing what we're doing. I didn't realize that 1 trillion was an ending point of some.
It certainly sounds nice.
Yeah, well, it's nice when you start with nothing. We've got a market cap now of $140 billion. We're the 5th largest financial company in the United States, after J.P. Morgan and Bank of America and Wells Fargo, and we're not a bank. And the 4th one's Morgan Stanley. We're $7 billion short of Morgan Stanley at the moment. So hopefully at some point, we'll be the 4th largest and the only non-bank to do that. I don't manage anything to a number. We're in the business of creating great products for institutions and individuals so that they can perform better than all other alternatives with safety. That's what we do.
Well, with that number, you definitely get more attention, though, and perhaps even more scrutiny. Jamie Dimon, for example, specifically called out Blackstone, talked about your industry altogether, but Blackstone saying you'd be dancing in the street about new banking regulation, that you would step in and do more lending, more private credit. Is he right? Were you dancing in the street after more banking regulation, Steve?
I like going dancing regularly, but not in streets. So we're just doing what we have been doing for a while, and it's been very safe for our customers. Very good performance with all of our debt products. As we look to the future, credit has been the most rapidly growing part of our business for the last 3 years. And to some degree, that's helped by central banks increasing the rate. So credit is now very competitive with other equity type products. And it has the virtue of being much safer than some of the equity products. But these things actually are cyclical. And when interest rates go down, real estate is really going to pop in terms of value and growth. And it'll also positively affect private equity. So for those of us who've been through at least 6 cycles, you look at all of this with a little bit of balance. And I think we're going to have a lot of opportunities for the firm to be growing.
To that point, I mean, you have a lot of men and women investing right now who have never lived with 5.5%. You've lived with it. You lived through higher rates. What do they need to understand about investing right now in a higher rate regime?
Well, I think you start thinking about alternatives in the sense And I mean alternatives within different things that you can do, that you can invest in certain credit products and get a 10, 11, 12% return with very high levels of safety. You learn that when interest rates go up, certain things you thought were wonderful become unappealing. Some of the super high-tech companies where people were buying them at multiples of revenue. I always know that that's a bad moment when somebody tells you you can buy something at 10 times revenues and the market's trading at 15, so you got a bargain. The fact is, it won't hold that value when interest rates go up. So you have to learn what fundamental value is. I know that sounds old-fashioned, but the people who don't do it really suffer. A lot of the venture stuff is down 50%. I think some of it's down a lot further. And so you learn to be in touch with more of what's safe with growth, as opposed to just anything works. For some period of time, everything did work.
Are we still overvalued, though, in those pockets that you're concerned about? Or has the valuations coming down in the venture space, has that normalized now? Are you still concerned we're still askew with fundamentals?
Well, I think we're probably still a little optimistic. You have to get through a cycle to see where things will really be worth. A lot of the venture business, where I'm not an expert, but it struck me that ever-increasing markups with no cash flow, ultimately, every time I've seen it, that stuff really goes down. And we're in that cycle.
How steep of a downturn are you expecting in this cycle in terms of a recession? Are you expecting one? Are you preparing for one?
I think we're going to do pretty well this time. We have very low unemployment in the United States. And that kind of environment is tough to have a serious recession.
What about a fiscal accident causing something?
Well, you can always have a trigger that really affects markets, which will affect an economy. We're running huge deficits, and we have more fiscal problems than we do normal business cycle problems.
Steve, you're asked very frequently about who you're supporting for the GOP, and I don't want to ask you that because I know you frequently say I'm looking towards the next generation. I want to ask about the next generation. Do you see that rising stars? Are you optimistic that there are those there who can carry the mantle?
I've learned there's always people who appear who you had no expectation. So when Barack Obama was elected as senator, it wasn't even within a year where he started running for president, and he became president soon thereafter. There are other people who will come and do that. American politics, I've found, at the presidential level is pretty volatile. The people you think are going to win, whether it was Hillary in 2016, they didn't win. Other people who were no place, they end up winning. In 2015, about where we are now for a presidential election for the Republicans, you had the governor of Wisconsin in first place. You had Jeb Bush in second place. You had Rudy Giuliani in third place. And by the time there were 2 or 3 primaries, they were all gone. And somebody named Donald Trump won, who wasn't even in the game. And so I think all the straight line predictions of what's going to happen, I sort of just sit back and say, I've seen a lot of volatility in my life of what the public wants. Apparently the public is not that interested in really older people.
Right.
I think there was a survey that said 77% of the people didn't want Biden to run again. And so when you have that kind of situation, usually something else happens.
Right. Well, Steve, I hate to put it in this light, but you're only a few years younger than the current president and the former president. How are you thinking about your legacy right now?
Geez, I don't think about legacy. You know, I may be a little delusional. I still think I'm younger than apparently you do. So as long as I have really high levels of energy, and I'm fortunate enough to have a simply amazing person, John Gray, who's president of the firm, who does stuff that I used to be doing. You know, I love what I do. It's fascinating. You know, it's global. We're learning all kinds of things every day. Plus, I have a very interesting philanthropic life, and also involved in the political world. So for me, those three things certainly beat retirement. Well, what would I do?
Yeah.
You know, this is so stimulating. Yeah. Plus, I get a chance to meet you. I'm here in Paris. You know, I have a certain enthusiasm, if you will.
Steve, I may be a millennial, but I know age is just a number. Don't worry. Thank you so much. Unfortunately, we're out of time. A pleasure to speak with you. Steve Schwartzman there. Manis, with that, of course, the Blackstone CEO, Steve Schwartzman. I mean, just interesting to hear him speak about all sorts of volatility, be it political, be it rates volatility, and sort of that hindsight and that history helping you navigate, again, both the politics and these markets.
It's fascinating to hear Steve talk about the cycles, and when this rate cycle ends, and we'll find out a little bit more from the dot plot tomorrow night, when that ends, you know, property will pop. It's not necessarily popping at the moment. It's becoming harder, and of course, higher rates. Danny, lovely line from Steve there. Higher rates. Where else do you want to be apart from, you know, high-grade credit? Great conversation. It's good to know I'm not the only one that sort of, you know, wants to keep on going, keep on motoring. Great conversation, Danny. How to make the head of Blackstone smile. Danny Berger and myself. We'll continue the conversation in just a moment. Danny in Paris, I'm in New York headquarters. And coming up on the show, another exclusive interview with the private capital titan. We catch up with the Oak Hill Advisors CEO Glenn August joins us later this hour as the OECD just released their latest economic outlook, raising the 2023 world GDP forecast and cutting 2024's. We'll hear from the OECD's chief economist in the next hour at 6:15 a.m. New York time. That's 11:15 a.m. if you're in London. Plus, UAW warns of additional strikes if progress isn't made by Friday as the walkouts enter day 5, right here on Bloomberg. This is Bloomberg Brief. I'm Menace Crenny in New York, Danny Berger in Paris, where she's been speaking to the leaders of private capital. And we will continue that conversation in just a moment. To our main story this morning, the United Auto Workers Union says it will expand its strikes if serious progress isn't made in negotiations. Oliver Crook joins me now. Oliver, where are we on these negotiations? It sounds as if it's fighting talk now at this stage. They're ramping up and roaring. Good morning.
Absolutely right, Manis. We're stuck at that 20% proposal from GM, Ford, and Stellantis to the union, which yesterday the president of the union, Sean Fain, said is a no-go. So what he said yesterday, he did a sort of media tour saying the ball is in their court and they need to come up with something better, and they need to do it before Friday at noon when they say they could expand this strike. And let us remember that we have less than 10% of the union that is striking right now. We're talking about 150,000 people potentially. If they wanted to, they could basically totally paralyze all of the big three North American operations if they decided to go that route.
Get down to business and work with us to make progress. Those are the words of Sean Fain, of course, who's leading this. He's almost become like an evangelist icon within this strike action. That's threatening to spill out of the United States. So what's happening north of the border in Canada?
Yeah, so just over the river from Detroit, you have Ford plants, you've got an assembly plant, you've got 2 engine facilities, and you have the union there. Their contract expired just a few hours ago. They are in negotiations right now with Ford. They want better wages, they want pension guarantees, and they want guarantees around EVs, which is really the music in the background of all of these conversations about the future of the industry. They said that they had substantive offer from Ford, so they've extended that window. They're not walking out. They've told everyone to stay at their jobs for the next 24 hours. But if they could, that'll hit the V8 engines. That goes into the Ford F-150s and in the Mustangs.
Okay, Oliver, I've got an image of you in a Mustang driving north of the border. Oliver Crook there, with the very latest on the auto workers and the messages coming from the unions to the bosses. Coming up on the show, it's an overhaul at Santander. We discuss the changes that are in store and why the Spanish bank is revamping the corporate structure. Will it deliver? Right here on Bloomberg. Another day, another structural overhaul at another bank. Today, Santander, the Spanish bank, seeking to simplify the business and reach its profit targets with measures including combining the retail and the commercial banking divisions under a new global unit. Bloomberg also learns that the change is likely to reduce the management layers and may indeed lead to some job cuts. And you just think, yesterday you had a big revamp going through. Welcome back to The Brief. I'm Manus Crenny in New York. Danny Berger on tour in Paris, speaking to the private capital titans. Here's what you need to know. The oil rally gathers pace. Brent touching $95 for the first time since November. Chevron CEO tells Bloomberg $100 is in sight. Job cuts could be on the way at Santander. The bank revamps its structure as its new CEO looks to simplify operations. Plus, we keep that private capital party going. Earlier, Blackstone CEO talked Europe, China, and recession risk. Up next, we hear exclusively from Oak Hill Advisors CEO Glenn August. But first up, let's give you a taste of what's going on in the risk markets this morning. You've got that Brent market above $95, again, for the first time since November last year. Ed Morse says geopolitics alongside technical trading could cause this market to top out. We listened to the Saudi oil minister yesterday, north of the border here. The jury is out on Chinese demand and rejects the notion that we're going back to the 1980s of pumping up prices. 10-year yields at the moment. The bond decision comes in with AllianceBernstein saying, buy these bonds. This is the time. It's ripe to buy. You'll make 20% on your bonds between now and the end of next year, going to 2.5%. SPUs are flat at the moment, up 1/8 of 1%. Oil, of course, it's got the musculature of sort of pushing in against the consumer. But the other side is the best performing index here. It is the energy complex with Halliburton, Conoco, and Exxon all pumping higher through the month. Danny, good morning. Well done on making Mr. Schwartzman smile. What's your top takeaway?
A few, but I think one of the most interesting, Manus, because you and I have talked about this for a long time. In a world where we no longer have base rates at zero, what is the new regime when it comes to investing? And it was just interesting to hear from Steve Schwartzman say, look, it's all a cycle. Things come in and out of favor. So at the moment, while there are all the concerns about real estate, he said, look, real estate will come back. So it's interesting to have that perspective in mind.
It is, and I think the essence of that conversation was he's lived through a number of cycles. Our next CEO has also lived through a number of cycles, which is high-grade credit. It's really rich, it's really appealing. You get 10, you get double digits and higher in high-grade credit in this rising rate environment. But of course, he has lived through a number of cycles, and he talked about property and he talked about recession risk, didn't he?
Yeah, he also talked about Europe specifically. Of course, I am here in Paris. We had to start with it. And Steve Schwartzman talked about the idea of slower growth and the U.S. avoiding recession. Take a listen to what he had to say.
Europe is slowing down. Inflation's still pretty high here. It's in the fives, and you can't stay at that level. And so the central bank typically would do what it needs to do to lower that.
Well, let's continue that conversation and the theme with Glenn August. He's the founder and the CEO of Oak Hill Advisors. Glenn, thanks for getting up early. Thanks for making it into the studio. You're listening to Schwartzman there talking about the resilience of the United States and the concern about Europe. Where I want to start the conversation with you is, Danny and I are looking at financial conditions tightening. The consumer, on the consumer side, not your world, is finding it harder and gloomier on access to credit. Through the prism of Oak Hill Advisors, how does the credit landscape look for you right now? Is it getting tighter?
No, I would say that there is more opportunity than it is tightening. Certainly the banks have pulled back structurally over the last number of years, but there's an extraordinary amount of capital available for companies. The lower end of the consumer side of the market is definitely tighter, but there is so much liquidity, there was so much stimulus, and that's really setting up for a pretty extraordinary credit environment.
So when you use the word extraordinary, what went through, Danny and I caught up before we had these conversations, so you use a word like extraordinary environment. That says to me we're nowhere near the top of the credit boom for your part of the world and your industry. So do we grow significantly from here? Because the banks are coming in and snapping at your heels, aren't they?
Well, the banks really have been held back by regulatory concerns and capital concerns, and they have really evolved into more of a syndicator as opposed to a principal investor, certainly in larger cap credit. And so when I say extraordinary, I just think that the opportunity to earn double-digit yields, which has been reported certainly broadly, is an extraordinary opportunity. Again, as you mentioned earlier, Steve Schwartzman mentioned earlier, when we were at rates of 0 and spreads were 4 or 5%, you were only making 4 to 5%. And today, the opportunity to make genuinely double-digit yields with a 5% plus base rate and spreads of 500-600 basis points, you have the opportunity to make 11+% on an unleveraged basis for senior secured risk, which is lower risk. And we have not had that opportunity really in decades. I've been doing this now for 36 years, and it was really back in the late 80s when base rates were much higher and you could make double-digit yields. But today, the opportunity to make, again, 11, 12 unleveraged returns in senior secured risk feels extraordinary to me. And to your question of growth, I think this is structural. I think we're here to stay because the opportunity set, because the banks have pulled back and the evolution of private equity is such that the demand for credit is there.
To that point, when you have the world awash in debt, $300 trillion worth of debt, what are the consequences of more of that moving out of the banks and more into you and your peers' hands? What will be the outcome of that ultimately?
So the question is not the magnitude of debt, in my view. The question is the structure of the companies that we lend to. And when I started in this business in a typical private equity transaction, you'd have 5, 10, 15, 20% equity in a transaction. Today, you have 50% or more. That amount of cushion gives us substantial comfort, and I think it really does change the risk-reward profile of credit.
Yeah, I heard something similar from the ICG CEO this morning too, Glenn. What then does a recession need to look like to be actually bad for credit and for private credit? What type of recession would you see a downturn in the space?
So, again, if I look back over the last 3+ decades, we've had a few major recessions, right? We had the 91-93 recession. We had the 01-03 recession. Obviously, we had the global financial crisis in 08-09 with the deep recession. I think it needs to get to that order of magnitude to have a meaningful impact. If you think back to 2008, when equities went down 30 to 40%, that's all it went down. And if you have 50% cushion and you've done your underwriting appropriately, we think there's substantial cushion. And I often tell the story that if you looked at our portfolio in June or July of 2008 and went away for a couple-year vacation and had no access to your phone or any internet, and you came back, we made over 35% over a 2.5-year period. And in our defaulted situations, we recovered 95 to 98 cents of our cost. So it really, in credit, like in equities, it's about selection. And I think there's a great opportunity to differentiate yourself in credit selection.
Glenn, where would you, I mean, if we take the landscape that everybody's spoken to Danny and I about, which is another rate hike, a soft landing, if I hear that word again, I think I'll sort of like, take the day off and go to the beach. But everybody's built this consensus narrative around this. So with that in mind, are you very comfortable with, let's say, US exceptionalism in this soft landing scenario on the credit side relative to perhaps the EU or the European credit market or the UK credit market? Does US exceptionalism hold in the thesis you've just given us?
So I don't think you need exceptionalism. Let's just start there. Whether it exists or not, we could debate. But what I would say is, in a world where there is slow growth, where there is a world where there's substantial cushion, that I think the credit outlook is very good, and there's not a lot of maturities. There's an abundance of capital to provide liquidity, and so I think the U.S. is in very good shape. And even if it worsens, I think there'll be substantial liquidity available to provide capital to those companies that need it. In the European market, I certainly share the view that there's more challenge there, but more opportunity. It's a different type of market, given the fact that the banks really have never cleaned out their balance sheets from 2008, 2009 in many respects. And structurally, there's more regulation. And so I think there's actually a pretty interesting special situations opportunity emerging in Europe.
Okay, stay with us. We'll pick up with the first question on that, and where are they, and what shape are they? Glenn August, our guest this morning, staying with Danny and myself, more about the booming credit market, private credit market, in just a moment, right here on Bloomberg. From New York and Paris, good morning.
As we look to the future, credit has been the most rapidly growing part of our business for the last 3 years. And to some degree, that's helped by central banks increasing the rate. So credit is now very competitive with other equity type products, and it has the virtue of being much safer than some of the equity products.
Blackstone CEO Steve Schwartzman speaking to Danny Berger in Paris just a little bit earlier this hour. Listening into that was Glenn August, founder and CEO of Oak Hill Advisors. You two must be on the same hymn sheet, which is, rising rates, get yourself stuck into high-grade credit. It's like bish, bosh, bosh. You talked about Europe just before we went to the break, and I'm curious to know, with Nouriel Roubini here yesterday, lambasting Europe and talking about stagflation, slow down, Germany, sick man of Europe, etc. Yet you say there are big opportunities to come in Europe. Where? Is it in leveraged finance? Is it in private credit? Where's the biggest growth in Europe and the biggest opportunity? Glenn?
Well, I think it's two places. One is, given that the banks are under regulatory pressure, I think to the extent that companies do face challenges from a very substantial weakening in the economy. Obviously, a soft China has a big impact on Europe. I think there's going to be opportunities to lend money into companies that need capital. That's number one. On a special situations, liquidity financing type of background basis. Secondly, we've talked a lot about the private credit market in the U.S. evolving over the last few years, such that 75+% of all larger transactions now involve private credit. Again, I don't think that trend is changing. Europe is somewhat behind, and I think that trend of providing private credit in new transactions is going to be a very, very powerful one. And so, again, I do think we're in this great era of private credit with high base rates, a relatively neutral economy in the U.S., challenging opportunities in Europe, but both special situations. And the whole idea that credit is basically attractive on a relative value basis to every asset class is really the first time you've seen that in decades.
And sectorially then, let's dig a little bit deeper into that. In Europe, if you're going to build out, are you going to be a little bit more guarded in terms of how you lend in Europe? Just run us through that growth strategy and maybe the parameters around that. Because if you're going to go into a fairly tough or a bumpy landing there. The opportunity to lend is there. But of course, the other side of that trade is perhaps the risk rises.
But you need to understand the structure of the market. The leverage finance market in Europe, actually, high yield market, is actually about 65% double B. So it starts with a higher quality market than the U.S., which is 50% double B, which, by the way, is materially better than it was decades ago. And so from our perspective, the big difference is you have maturities coming due in the leverage finance market in Europe. And again, if there's not regular way capital to provide that refinancing, we think there's going to be good opportunity for new capital to come in. And obviously, in everything we do, you need to be incredibly selective. We're not blind to the idiosyncratic or the macro challenges, but that doesn't mean there aren't high-quality companies that need capital, and rather than accessing the public markets, they'll access the private markets.
Glenn, I can't help but wonder, with this space becoming more popular, fundraising rounds getting bigger and bigger, is everyone being selective, or do you see managers who potentially chase deals because they had to put money to work coming under pain in the coming months, coming years?
So a few things. Number one is there is certainly a growing supply of capital that we have and our peers and competitors have. But there's also an extraordinary amount of demand. One of the things I like to talk about is the evolution of the leverage finance market. And today's market is such that the syndicated loan market is predominantly executed through CLOs. The U.S. high yield market is predominantly double B credit. And so when large private equity deals get done in growth equity type of industries, they need to access private markets. So first of all, there's a great demand, and that demand and supply is actually setting out to a place where we think there's good value. Secondly, we have been in a world where there has been very, very little differentiation of managers and of performance because we've been in a benign backdrop. One of the things we like to highlight with a firm that has a 30-plus year track record is we've navigated the ups and downs. At the end of the day, we will see some of the new entrants, whether or not they can navigate a more challenging market when that market comes. In the interim, there will probably be less differentiation, but we think over the medium term, as things do ultimately soften, there will be more differentiation.
What are the consequences of that, Glenn? Could there be consolidation among managers?
You know, look, I think you've seen consolidation in the alternative asset space. Ultimately, there's been mega trends where the largest investors in the world have decided they want to have fewer managers and much deeper relationships. And so those investors want to work with partners that can provide them multiple products. So I think you'll continue to see product consolidation. Secondly, there's clearly a mega trend going on in the wealth channel where the individual investor has been underinvested to alternatives. One of the comments I like to make is, why should the dentist in Texas not have alternative exposure, but the teacher does? And that's because the teacher has a teacher's pension fund, whereas the dentist is doing his or her own investing. And so I do believe this mega trend of individual investors getting access to alternatives is going to grow. So I think you'll see channel consolidation. I think you'll see product consolidation. Clearly, one of the other mega trends is exposure to alternatives in insurance companies. There's been lots of transaction activity and products getting customized to service the needs of large insurers. And so the alternative asset space, and again, I've been doing this for 36 years, continues to evolve in a very exciting way. And I think there will continue to be meaningful growth in the sector.
So the mega trends, and you've been through a few cycles to say the least, Glenn. With that in mind, there's an obsession. I mean, I've arrived in New York, blown away by the property market here. I'm a broke man, and it's day 7. But on a much broader scale for you at Oak Hill Advisors, Bank of America wrote that the boa constrictor around the U.S. economy was commercial property. People are tuning in. It's 5:49 a.m. in New York. Let them walk away with your view on property, on exposure to that. Where are you taking more? Are you prepared to take more? Do you have a big megatrend view on that?
So I would say that we are cautious. Unlike corporate credit, which is relatively stable in a benign environment, I think we're still processing a few things. One, the secular changes in real estate. Obviously, office is one segment, but business, hotels, and so on. So this COVID chapter we've all been going through over the last few years is having its implications, and we don't know where those ripples end. That's number one. Number two, with rates up materially, the value of long-dated cash flows is lower. And so the cushion that's in real estate today is less. And thirdly, the capital markets today in real estate is somewhat broken. The securitized markets are much more challenged. There's lots of debt coming due. And so I do believe there will be real opportunity, but I still think it's a little bit early. We're looking at lots of things on a relative value basis, and we're ultimately all about maximizing risk-adjusted returns and finding attractive relative value. We think in real estate we don't see it there just yet.
Okay, Glenn, that's a thought for the day for our viewers from Paris, New York, and London, and around the rest of the world. Glenn, thank you very much for getting up early and joining Danny and I. Glenn August, Oak Hill Advisors CEO. Coming up in the show, a look at some of the market-moving events to watch throughout the day, right here on Bloomberg, as New York wakes up and gets set on Bloomberg. This is Bloomberg Brief. I'm Menace Granny in New York. Danny Berger in Paris, where she's been catching up with Mr. Schwartzman at Blackstone. Danny, good to see you this morning. You get the glamorous tours, but I'm very happy to be here. Look, we didn't get to the China conversation with Glenn August. We decided to go down the route of property. But Schwartzman's take on China, I think, is interesting. It's about confidence and the lack thereof and the hammering that people have had in the property market.
It's true. And look, he expressed those concerns about the property market. And when I asked him, OK, what does that mean for Blackstone? How do you invest in that uncertainty? He said, look, us and most people in China are in this wait-and-see approach. But he was confident that China growth would come back. But it's interesting. You can't quite time that, right? It seems to be what he was saying, that you can't time it. So in the meantime, you just kind of have to wait. But elsewhere, Manis, we've seen survey, we've seen the flows. The world is quite dour on China at this moment.
Yeah, and we didn't actually get that far with Glenn, but of course his viewpoint of the world was around Europe, where he sees special situation. He's going to be a little bit guarded, but he sees the opportunity. It sounded like almost a bigger opportunity for him in Europe. Yes, you've got the safeguard of the US, but Europe seems to be the land of where he sees, well, not so much milk and honey, but the opportunity. And then, of course, in property, a little bit guarded, I thought, on the comment there. And it has to do also with what the banks are doing, too. I thought that was an interesting dynamic of him talking about the banks retrenching. So liquidity is needed. So that's where folks like Oak Hill, the rest of the private credit space, where they can step in and find opportunity. OK, well, listen, we can reset the agenda tomorrow. We're going to get back to basics with markets because, of course, it is Fed Day. We'll see what that old dot plot gives us. Will it guide us to 4 rate cuts next year? Bloomberg Brief will take you through it. We've got Seema Shah, Principal Asset Management. Paul Donovan, UBS Global Wealth Management, joins the brief tomorrow. And that's it from New York and Paris. There's special coverage of surveillance. They're live in London with the OECD's chief economist, amongst others. Good morning from New York. Good afternoon from Paris.